Hey everyone, welcome back to Financial Fix Blueprint. If you've been paying attention to the news lately, you've heard the big headlines. Central banks, like the Federal Reserve and others, are cutting interest rates. For years, rates were high, which was great for your savings account, but brutal for borrowing money. Now, the tide is turning, and this shift may require a change in your personal finance strategy. If you don't act now, you could be leaving thousands of dollars on the table, either by earning less on your savings or missing out on key investment moves. Today, we are re-breaking down exactly what falling interest rates mean for your life. Before we dive in, it is crucial to understand this. The information presented in this video is for educational and entertainment purposes only. We are not financial or investment advisors. All content, including examples and strategic suggestions, is based on personal opinion and research. It does not constitute personalized financial, legal, or investment advice. Before making any financial or investment decisions, always consult a certified professional who can assess your individual situation. What falling rates mean first, let's quickly explain the shift. When central banks lower the key interest rate, they are signaling two things. They want to stimulate the economy, and they want to fight off the risk of recession. They do this by making money cheaper to borrow. But here's what this means for you. Debt gets cheaper. Think mortgages, car loans, and business loans. New debt becomes less expensive. Savings get weaker. The interest rate on your high-yield savings account will drop. That great 4 to 5% rate you were enjoying, it's slowly going away. Stocks get a boost usually. With cheaper borrowing, companies can expand more easily, and the incentive to keep cash in a low-return savings account decreases, pushing money toward the stock market. The key takeaway is this: you can no longer rely on high savings rates to build wealth. You have to be proactive. Crucial move number 1. Attack debt and lock in low borrowing rates. This environment is fantastic if you have existing debt or are planning a major purchase. Mortgages. If you are thinking about buying a house or refinancing, this is your golden window. Lower rates can save you tens of thousands over the life of a 30-year mortgage. Even a 0.5% drop matters dramatically. If you have credit card or personal loan debt, consider consolidating it into a lower interest personal loan or a balance transfer card while rates are favorable. You are finally getting a break from that dark side of compounding we talked about. Action. If you have debt, research refinancing or consolidation options now before rates potentially creep back up or before you miss the best deals. Reevaluate your savings and shift long-term cash into investments. This is the most critical strategic move. Remember what we said about saving versus investing? Saving is for security, the next 1 to 3 years. Investing is for growth, 3+ years. When your savings rate is high, it acts as a decent growth tool, but when it falls, inflation will quickly start eating away at your principal. Emergency fund. Keep your 3 to 6 months of expenses in the savings account. That's non-negotiable security. Long-term cash. Any money intended for a goal, 5 years or more away. Retirement. Child's education. Future major purchases needs to be actively invested. The difference between earning 2% in a savings account and a historical average of 7 to 8% in the stock market is the difference between struggling and succeeding. Action. Take that long-term cash and allocate it to diversified low-cost investments. The market is getting cheaper to access, and the incentive to grow your money is stronger than ever. Optimize your safe money with fixed income alternatives. Since your traditional savings account is losing its shine, you need to find where else safe money is sitting. CDs, certificates of deposit. Banks are still offering good rates on long-term CDs. If you know you won't need money for 1 or 2 years, locking in today's rates in a CD can ensure you earn a higher return than the likely falling savings rates over that period. Bonds. If you have a larger portfolio, bonds and bond funds become appealing. They offer stability and can continue to pay competitive yields even as central bank rates decline. This is often where smarter money goes for reliable income. Falling interest rates are not a problem. They are a financial opportunity. They force you to be smarter and more strategic with your money. Lock in low rates on any new or refinanced debt. Shift long-term savings into investment vehicles. Optimize your short-term cash by looking at CDs or other fixed income options. The power of compounding relies on growth, and you can't get that in a low-rate savings account. Start acting now. If you found this advice helpful, please hit the like button and subscribe.